Good morning, good morning, good morning. Welcome to the Millionaires in Training, our Money Mastery session number 3. I'm your host today, um, Kim Bakshi, and I'm assisted today along with Sahil Bakshi. We have Minesh Baxi here, and he is joining us today as well. And we are missing our other family member. Her name is Macy Bakshi. So welcome, welcome, welcome. All right. So today we have a great um, topic regarding, money. So let me bring up my screen and we really thank everyone for joining today. So today we'll be covering the three topics today, the biggest mistakes people make when buying life insurance. Also, we'll talk about how to get out of debt, including your mortgage, 5 to 10 years sooner without increasing your monthly payment. And we'll talk about how to calculate your financial independence number. So, as we get started, a lot of us want that financial freedom, and money sometimes definitely weights a lot of us. So, let's start here. All of us um, have been working for money. We work hard, we're very passionate, we love what we do, and hopefully you are compensated. And so I want to begin our topic today is where did your money go? So in your mind, or if you have a piece of paper nearby, think about your average income. What did you earn? Then also think about how many numbers of years you worked. For some of you, it may be 1 to 2, and some of us a lot longer, 20, 30 years. Okay. Now, total your income over the years you work. So if you worked for a couple years, you'll have a number. If you worked for many years, you'll have a different number. Okay. So you should have that set aside. Now, I want you to have and examine what is the total savings set aside. So that should be another number. Okay. So again, really quick, total number of years you worked with all that income, your total savings. For some people, it's a match. Some people, it might be in balance. One might be higher than the other. So where does that leave people? So that means, one part that we want to look at is how to make those numbers closer to each other or maybe accelerate. And so I want to revisit a concept of building your financial house. So here are kind of the building blocks, just like you have a house, you have a foundation, you have bricks, you have layers, and you have a roof. So first part that we would like to really examine is, do you have a strong financial house? What are you building? Some of it might be stronger, some of it might be a little weaker, but don't worry, we can work on making it stronger. So the first area is your foundation to your house. And so do you have something called income replacement? So you're working hard. Have you ever thought about what happens if my income goes away? Meaning, should you pass away, do you have term life insurance in place in case the unexpected happens? Will your loved ones have the financial resources to continue? So we would be very sad if something happens, but we want your legacy and your family to be taken care of. Number two, as you're building your financial house, um, setting aside an emergency fund. And that requires, budgeting and setting aside. So emergency fund would be something like, hey, flat tire or something in your kitchen, there's a leak, you need to call in the plumber, a little emergency. part of building your financial house is debt elimination. So for many people, that debt elimination is very critical because sometimes we have more debts than the income coming in. Okay. And when also with your emergencies fund backing up, we recommend 3 to 6 months set aside for an emergency. Okay. Simultaneously, you want to be looking at, hey, there will be a time that you will not want to work and that you want to enjoy retirement, but you still want to have that money coming in. So, do you have a plan for your paycheck to still duplicate and have money coming in even when you're retired? And that requires planning to become an investor. And last, for some people, college savings for your children is important. Alas, this is one part that often is neglected is do you have a will? Keeping your financial house intact. Because sometimes when things happen, if you don't have will and you don't have a living will and power of attorney, a lot of devastation can happen where the money just goes into probate and it's not left for the heirs. Okay. So that's the big picture of what we're going. So one area that is very challenging for people is the debt, um, solving with that debt. And so I just want to give you an example that typically younger people have credit card debt. So in this example, you'll have a set aside amount of debt set aside, and it's a commitment. So it could be a combination of credit card debts, car loans, mortgage. So I just want to give a concept of how to accelerate your debt with what's known as debt stacking or debt snowballing, and just really being very intentional in paying off that debt. So here in this example, typically with a mortgage, loan, credit card, this person who's age 35 is using $2,720 of their income paying off debts. Okay. And most people are probably willy-nilly of, hey, pay off this, pay off that. But if you're very intentional of paying off one debt at a time, then taking that amount and applying it towards your next debt, and so on, and just kind of doing like a snowball effect or stacking, you will eventually chip away and pay off your debt much sooner. So if you don't have a plan, it could take much longer. If you're very intentional, it could be 5 to 10 years sooner. And not only if it's just sooner, you're avoiding that interest as well. So it's not just only the debt, it's that interest that's really drowning most Americans. So once those debts are paid off, then you can free up the money, and we suggest putting it towards your retirement. So, Sahil, tell us a little bit about bypassing the middleman.
Absolutely. Thank you. So just going into here, right? This is bypassing the middleman, which is meaning you're becoming an owner of your money and not a loaner. So how many of us were actually taught how money really moves? Because here's the thing, most people, they work hard for money. They hand it to financial institutions, but they never really understand how the ownership works. So banks and insurance companies, they understand long-term investing and compounding extremely well. The question is, are we learning the same rules that they use? Owners think differently than consumers, right? Consumers spend and owners learn how money grows. Because the wealthy often buy assets first, and most people really just buy liabilities first. Now, this one concept here, this is the rule of 72. And this really changed how I think about money. The rule of 72 shows approximately how long it takes for money to double. So you can see in the columns and the rows here, right? Starting at, the first year, right? You're starting at 3%, 10,000. At age 24, that would be 20,000, 6%, that for 24, that would be 40,000, and at 12%, that'd be 160,000. Now, most people, they spend years working for money without truly understanding how powerful compounding, actually is. So, think about this. If nobody ever teaches you these rules, then how are you supposed to play the game effectively? Now, don't pay the high cost of waiting because time is one of the biggest financial advantages that you can ever have. And I've seen it before, and it's something that you need to take advantage of. So I'm 18 years old right now, and because my parents understood the cost of waiting, I already have a little over $20,000 saved. And I'm gonna be honest here, guys. That didn't happen because I'm special or unique or in anything in that way. It happened because they started teaching me, and they started teaching me early. Because most people think finance is only about how much money you make, but a lot of times it's actually about how early you start and how consistent that you actually, become. So if you take a look here at 25, it takes around $200 a month for saving. And then at 55, it takes almost $4,000 a month to actually try catching up. So waiting here, right? Waiting has a cost, but learning early will actually be able to completely change the direction of your future. So I wanted to talk a little bit about that. It's very, very important that we understand what it means for the cost of waiting and that we take advantage of it now, early, instead of later. So I'm going to pass the torch back on to my mom. Thank you so much.
Okay. All right. Excellent, Sahil. So, okay. And the last topic to wrap up today's session is the topic of insurance versus investing. So, obviously, we talked about the foundation of making sure that you have the proper insurance. And we really recommend that because sometimes unexpected things happen. That's when insurance comes in. But at the same time, we need to work on investing and debt solutions and etc. So just want to reiterate to make it very clear, and I think it gets really muddled up in the news and on TikTok. Just think there are two tools, there are two jobs. Very simple. Insurance protects what you have. So we have life insurance, car insurance, homeowners insurance. Okay, very clear. I would also like to rename life insurance as income protection insurance, if that's a better way for you to think about that. On the other hand, investing, that's taking money that you are wanting it to grow and build. This is one of the biggest mistakes I think people get confused with life insurance because some people think that life insurance is an investment vehicle. And that's really what it's not built for. Okay. So again, insurance, think of it as protection. It replaces the income if something happens to the person who's earning the income, the family is left secure. Okay. It is for the peace of mind. Insurance was not designed for growth in the investment in trying to beat the stock market and trying to be a retirement account. I think when they try to blend the two, it's not feasible. So I want to give you a little example. Two 35-year-olds to kind of give you a little clarity. Same goals, same budget, and let's have an income of age 65. So obviously you want insurance, income insurance to protect a family in case something happens. Of course, all of us want to build wealth for retirement. And let's say in this example, $500 is a set aside for that budget. to go for those goals. Okay. All right. So, example person one has what's known as cash value life insurance. So they put away $500 a month towards a cash value life insurance policy. Okay. So it's usually promoted as, hey, buy life insurance, it will accumulate and you'll get cash at the end. So here's the reality. Typically by age 65, so if you're putting away $500 a month, the accumulated cash value is approximately 350,000. So why is there lower growth? Well, here's the fact. A portion of that money that you pay towards that cash value insurance is going to go towards the insurance costs, fees, commissions, guarantees. Less of your money is working for you, more is working for that insurance company. Let's look at person number two, term insurance and investing. So this is what we highly recommend. Buy term life insurance or term income protection, and then take the money that was not spent, that leftover money, and use it towards investing. So, for example, if your budget again is $500, for $50 a month, buy term coverage. Take the remainder of $450 and put it into your own investment account, right? Mutual funds, index funds. So by age 65, you potentially could have $1,000 in your retirement account. So nearly all that money that you've set aside compounds. The market is working for you, not for the other example where for the insurance company. So that's the power of leveraging your money. You're working hard to earn that $500 you set aside. Let's maximize it for you. Okay, so here's again the recap side by side because I kind of separated. Again, client A, client B, cash value person, $500 a month cost, and then they are hoping at age 65 that they'll probably have $350,000 in their cash value, which is what's known as their investment. All right, so that's one number. Client number two chose to go with term insurance and then take the difference and do their own investing. Again, still $500 a month, 50 towards life insurance, term life insurance, 450 towards their own investment. Their retirement account estimated would be closer to $1 million. Same budget, same 30-year window. It's just where did that money go? How much does it get compounded? And whose account is it for? Right? That's really shocking. Just a simple way of thinking, insurance is for, like the car analogy. You're in the car, you're using insurance as like your seatbelt. So you're sitting down, you're buckling it, and just in case something happens, that seatbelt, term life insurance comes in just in case there's an emergency and there's an accident. Okay. Now, that car, hopefully nothing happens like that. You want your car, and think of your engine, all that money that you're investing. You want that engine to move forward towards your financial freedom. Um, and, um, and that's where you have that money set aside so that you have a powerful life. So one is for emergencies, one is for the future. You'll need both. And they do different jobs, but together, if you have a very intentional plan, you'll have a stronger financial house. Just recapping, the insurance protects your family just in case there's a worst case scenario, so your loved ones are never left without support. Investing builds your wealth so that you can retire with confidence and financial freedom. All right. I know that's a lot to take to kind of absorb, which is why we've built a community that is free called School. And Sahil, if you can put that in the chat, you can, we invite you to join because we have these recordings set aside for you to kind of go over these concepts. So today is session number 3, and if you have friends that this is very unfamiliar, we invite them to join our community. So Sahil, if you can put our the link in that chat, that will be very helpful. And we would love for I'm now just reading our chat. So, okay. Oh, and Minesh was talking about in for future sessions, he would love to invite people to teach. So I'm going to open it up to what's one key takeaway that you got from today's call. So, and we'll open it up if you can talk and unmute.
Taking away the recognition, and I apologize if there's noise in the background for me today. I'm taking away the fact that I recognize I didn't start as soon as I would have liked to, and there might be many people on the call that are kind of thinking like, well, I don't know if I'm this old or if I haven't started by now, or I only make 50 grand a year, or maybe it's only 30 or 40. And that's okay. What's striking me in the back of my mind is like it's better to do something now than to let that mindset continue to keep you in the same pattern because nothing is going to change. So I really value the information that you guys are given, Kim and Sahil and Manesh, and hope that everybody takes action on it, and am committed to do that myself as well as we're on the call.
Absolutely. Thank you so much. And that is true. Uh, what you've explained is not uncommon. I think a lot of us, and I'm guilty too, started young, didn't start soon enough because I think you're overwhelmed with, I got my job, I've got this debt, and you don't think about it. But just like Rachel's saying, if you put a little amount away now, just a little amount, I'm not saying put away $10,000. I'm just saying, hey, 100, 200, 400, whatever's in your budget. Now, then when you're 65, you don't have to worry and stress. So great job. Yeah, thank you. That's a lesson that I did not learn sooner, and that's why we are here sharing that. And thank you for picking that up. So raise your hand virtually if or if you can't speak up.
Definitely the fact of that at 25, if you start saving $200 at 65, you'll have a million is something that I didn't know. Honestly, I'm only 26, so I have a few thousand saved up, so I'm not too far behind as to what I want to be at, but I can still catch up. And most people my age don't really even know that if you do that, that you can get a million. Honestly, it's something simple to do. Why not do it?
Absolutely. And that's why we give hope in these conversations. So uh, we built these sessions so it's the information, but also we give impact. Because if we can share this and help another person, that makes the community and the world much stronger and less stress and more happiness. Okay, so and please, thank you and congratulations, Jamara. I'm glad you have that great shift in your mind and in your thinking. Anybody else?
Yes, I want to say something. Yes, so I want to thank Kim and Sahel for the presentation. It was clear enough for us to even apply to our own personal financial situation and also to share with others. Um, Yesterday when I was in Detroit, I went to church on Sunday and we stayed the night, and I was with my cousin and I was talking to his wife, and I've been talking to her about the past maybe 2 years, and she told me she has a life insurance, and I have told her, can we take a look? She's been playing some game. Oh yeah, I'm gonna go there. But anyway, it's been over a year. Finally, today she opened up, and when we try to see a little bit of what the document that she has a whole life. So I told her, actually before me, someone, an agent from I don't know what company, approached her and discovered that she had a whole life and told her that it's bad. so so now she was open when I was talking to her in church Sunday. She was very open because she already had someone telling her that what she has is not good, right? To say that we have a valuable information that we can help people with. So that's really my point here.
Thank you so much. Any last moment?
Well, I'd like to interject, if I could, that how blessed Macy and Sahil are, to have you guys mentoring them like directly and so closely. And, this is something that every young person needs to know. Um, I didn't even teach my own kids this, but it's not too late. They're in their 20s, so I can still catch them before it's too late. So I'm very happy about that. And then catch their friends and catch everybody in my sphere and beyond. So it's a really wonderful thing.
Absolutely.
Yeah.
All right. I'm going to show, I know a lot of people are very visual learners, so hence that's why we have that PowerPoint. Again, please invite people to join to our school community. It is free. Sahib did put the link in. And so if you are a visual learner, here we go. Okay, it's you just you sign up, set up a profile. Here's the millionaire in training, and so we already recorded session 1. Here's session 2, and then soon we'll upload session 3. So it's a great community because definitely we should encourage everyone and support everyone in this endeavor. So, all right. Any last minute thoughts, Sahil, before we wrap up?
No, I think we have all got it covered for today. I appreciate everyone who, came here today, especially, Shannon, Jamari, Kwaku, Rachel, all sharing their own thoughts. Really appreciate everyone for taking the time to join. You are already, couple steps ahead of the game for most people. So make sure that you guys are giving yourselves props and a pat on the back for that.
Okay. Oh, and Sahil, why don't you say one last thank you because there's a couple of people I don't think are in camera. You can look in the participant role. So really, thank you. Go ahead.
Absolutely. Of course, again, thank you, Shannon. Great to hear from you, Jamari, Kwaku, Rachel, Keisha. Great to see you here today as well. Thank you, of course, to my dad here. We thank you, Simona. Thank you, Susie. Thank you, Hannah. Thank you, Nicole. And thank you, Xavier, for all taking the time to join us today. Great to have you.
Thank you so much. You have a great morning and a great day.
Bye.
Bye-bye.